Years of democracy, a stable exchange rate, and a historic debt cancellation deal with the Paris Club group of lenders put Nigeria's bond market on the radar of fund managers in 2006.
When the federal government came back into the bond market in 2003 with one very big four-part issue, they didn't attract very much interest. As they came out with new issues in 2005, some of the international banks started to buy those bonds. And then when the primary dealer market maker group was put together so that you had a liquid bond market, there was quite a lot of interest in 2006 going through 2007. Now the rates in 2006 were around 12.5% for 3 years and 13.5% for 5 years. Those rates dropped down into single digits and the foreign investors left. They're just starting to come back now that we've seen these rates come back up again. And the alternatives globally are not, frankly, very attractive in comparison.
There has been a repricing across the yield curve over the last 6 months, with increased supply from the Debt Management Office and investors paying more attention to year-on-year inflation levels, which came at 13.4% in October. The yield on the 20-year federal government bonds, for example, have risen from 7% in June to over 14% today. Nigerian bonds are beginning to stack up attractively against other sovereign bonds in sub-Saharan Africa. The 3-year South African government bond, for example, currently trades at 7%. In Kenya, the yield is around 4.5%. The Nigerian 3-year bond, however, currently provides a yield of around 11.1%.
Clearly against the European markets, the Irish bonds are trading about 8.5. So to get a 3-point premium coming into Nigeria that has a pretty strong fiscal position in comparison to Ireland, even though Ireland has the EU behind them, I think that at 3% spread I would be intrigued with Nigeria. Greece is at about 11.5%, which is roughly what we are here. South African rates are down in the sort of high single digits, 10% I believe. So we've got a spread against them. Other markets like Indonesia, which is a very natural offset to Nigeria, are also down around 10%.
With oil prices reaching $90 per barrel, oil production now firmly up above 2 million barrels per day, and considering Nigeria's $33 billion foreign exchange reserves, analysts point to a decline in currency risk for those looking to venture into Nigerian bonds. Some market watchers also point to the takeoff of AMCON and the bonds that the state-owned asset management company will issue in exchange for bad loans as another possible catalyst for the Nigerian bond market.
They were going to issue a 3-year zero coupon bond, and that what they were going to do was they were going to use these bonds as currency for paying for the NPLs. That there would be one tranche of bonds, so therefore you have liquidity, and that the bank would get those bonds in lieu of cash for their NPLs. If they do that for the whole trillion naira that they are expected to need, they're certainly going to have a big effect on the short end of the market. Those bonds, that market currently is trading in the 11 to 11.5% range. I would expect with that amount of supply, you'd probably push those rates to 13 plus.
While downside risk cannot be ruled out, the Nigerian bond market is one discerning investors should begin to look at in a world where interest rates are expected to remain low in the foreseeable future.